Okay, let's just jump right in. We're unpacking Poet Technologies today. And if you've been tracking the market, you've seen the price moves, the volatility that comes with any of these high growth tech plays. But honestly, anyone just watching the stock price is missing the real story here. This company is sitting right on the edge of a massive technology inflection point.
That's the core of it, really. It's no longer just a promise coming out of a lab. We're seeing, well, undeniable market confirmation.
Right.
They recently secured, what was it, $5.6 million in Q3 orders. That alone signals that demand is genuinely accelerating for their circuits.
And that's just the internal signal.
Exactly.
Yeah.
And maybe even more powerfully, you have the industry buy-in. I mean, the Marvel acquisition of Celestial AI is basically validating Poet's entire technological approach.
It validates the entire space.
It does. And that doesn't just confirm their strategy, it de-risks it significantly for the bigger players, for the institutional money.
You nailed it. This is a crucial turning point. We're moving from an R&D promise to commercial reality, and that's what we need to analyze today.
Exactly. You're tuned into the Easy Money Show, where we try and make sense of these complex market moves. We're glad you're with us.
And if you're enjoying the analysis, the effort we put into these breakdowns, make sure to subscribe and hit that like button. It genuinely helps the channel grow. And definitely drop a comment and let us know which stock you want us to simplify next. All right, so now that we've set the stage with that big growth picture, we have to start with some caution, because right now the financial reality is tough, and that introduces some very real risk.
It's the elephant in the room, isn't it? When you look at the Q2 2025 results, the immediate financial picture was, well, it was challenging. Revenue came in lower than consensus, just 0.3 million versus an expected 0.55 million.
And that miss directly contributed to a net income loss that widened a lot. We're talking negative $17.26 million. For a listener who isn't, deep in these pre-revenue growth stories, that number can look absolutely terrifying.
It can. It absolutely can. But you have to look closely at the nature of that loss. This isn't them just, burning money.
It's an investment.
It's an active investment in their future. They are front-loading a ton of R&D costs right now to get ready for their commercial ramp-up. Think of it like building a massive state-of-the-art factory before you've sold your first million widgets. It takes enormous upfront capital, which, yeah, it sinks your margins in the short term, but you have to do it to hit that future scale.
Okay, but even with that justification, the present metrics are painful to look at. We're seeing deeply negative margins in this early production phase. So given the unprofitability, the negative cash flow, I have to ask about the valuation. They're trading at 13.9 times price to book. For listeners who maybe don't follow that metric, PB compares the stock price to the company's actual physical assets. Why is 13.9 a potential red flag here?
That is the essential question for anyone making the bear case right now. For a stable, profitable company, a PB of nearly 14 would be extremely high. It would signal massive overvaluation. In Poet's case, it shows that the market is assigning almost all of the company's value to the intangible.
To the story.
To the story, to the future success of their tech, not to their current balance sheet. And that highlights a major vulnerability, right? If they miss revenue targets again, or if there's any delay in execution, that valuation gets very precarious because the current earnings just don't support it.
So the immediate risk isn't really that $17 million loss itself, it's the possibility of delays.
Precisely. The number one risk isn't the cash burn. They plan for that. The risk is execution. Can they scale up production of the optical interposer fast enough? Fast enough to turn those orders into real revenue before the market just loses patience. That's the primary threat here.
Okay, and this is where the conversation really shifts, because the bull case, the optimism, it's not just wishful thinking. It's rooted in a genuine proprietary technological advantage. They have a substantial moat, as they say.
And what's fascinating is what the tech actually does.
Yeah.
We're talking about the optical interposer platform. To put it simply, they are masters of something called heterogeneous integration.
Okay, break that down.
So if you think of traditional chips, you have separate pieces, right? The silicon chip, the laser, the optics, all packaged together in a really complex, costly, and power-hungry way.
And Puet does it differently.
Completely differently. They integrate all those different materials, the light sources, the optics, the electrical connections, onto a single, standardized, low-cost platform. It's a structural improvement. And this integration allows for photonics, which is just light-based data transfer, to connect seamlessly for high-speed AI data centers. And the key advantage over traditional silicon photonics is twofold. Lower power use and lower cost.
And lower power and lower cost are the two holy grails for the entire AI data center industry right now. I mean, as these models get larger, efficiency isn't a luxury anymore. It's mandatory.
Exactly. And that advantage creates incredibly high switching costs for their customers. Once a big cloud provider designs this platform into their ecosystem, it becomes extremely difficult and expensive to switch away. It essentially locks in the customer.
Which makes that external market confirmation we talked about so much more powerful. Why does that Marvell acquisition of Celestial AI specifically validate PO it?
Because it's a signal from the whole industry. It confirms that this kind of integrated photonics architecture is the future for AI connectivity. The big players like Marvell are basically saying the old ways of moving data around an AI cluster are dead. The future relies on these highly integrated light-based solutions. That acceptance by big tech is what de-risks POET's entire strategy. It tells you they're solving the right problem, even if they're still early.
Okay, let's circle back to that demand. We mentioned the 5.6 million in Q3 orders. That shows customer belief. But if we look under the hood at the operational data, what stands out to you?
The most important detail right now is that early production is showing strong gross margins. Remember all that ugly stuff we said about negative operating metrics and high R&D spend?
Yeah.
Gross margin shows the profit on each unit sold, but before all those other costs. Strong gross margins suggest they have a high-value product that costs very little to actually make once the factory's up and running.
So if they hit volume, that strong gross margin should create immense operational leverage, meaning those deep negative numbers could flip into the black relatively quickly.
Precisely. And they have the money to get there.
Yeah.
They did a huge $250 million equity raise. That gives them a massive cash reserve, which is vital. It means they can focus entirely on scaling up and delivering on those orders without the pressure of, going back to the market to dilute shareholders again. They've bought themselves time.
Now let's pivot to the technicals. Momentum players are definitely watching this, and the story is showing up on the charts. We saw shares gap up recently, right? Moving from the mid $6 range on really high volume.
Over 1 million shares.
1 million shares in a single surge. It's creating higher highs, and it's happening right in the middle of all this AI hype.
Yeah, the technical picture is definitely confirming the fundamental shift. The stock is now trading confidently above two really critical long-term signals, the 50-day moving average and the 200-day moving average. Trading above both means the short-term and the long-term trends are now decidedly bullish.
And we are right on the verge of that classic technical indicator that often triggers the algorithms, the golden cross.
That's a powerful signal. A golden cross is when the faster 50-day moving average crosses above the slower 200-day. It signifies a pretty decisive shift from a long-term bearish trend to a long-term bullish one. And when that happens, technical traders and, like you said, the algorithmic funds, they often pile in, which adds a lot of momentum.
So are the analysts and the institutions buying the story, or are they just trading the charts?
Well, we've seen some research firms raise their price expectations. They're interpreting this surge not just as a reaction to the news, but as a resolution of a technical accumulation pattern. They think the stock is technically breaking out.
And what about institutional ownership? It's still low, right?
It is still very low, which usually means the biggest funds are waiting. They're waiting for that revenue conversion we talked about. They want to see the execution risk fade. However, we did see new stakes emerge in the last quarter of 2025, and that signals some early accumulation. Some players are placing their bets now, before the golden cross and before the big revenue reports hit.
And you can't ignore the speculative chatter.
No, you can't. There's significant market chatter about repeat AI orders coming in and the possibility of a short squeeze ahead of the next results. This is all being fueled by a surge in options activity, specifically call options, which suggest the market is betting on a strong outcome.
So what does this all mean for the next few months? If you're tracking this company, you need to mark your calendar.
The main event is the next earnings report. It's expected late February 2026.
Yeah.
And the entire market will be focused on one thing and one thing only. How effectively did they convert that 5.6 million in Q3 orders into actual recognized revenue in Q4? That's where we'll be comparing against the current full-year EPS expectation of negative 45 cents. A strong conversion rate changes the narrative overnight.
And beyond earnings, we should be watching for customer updates, maybe at some of the big industry conferences on AI photonics. Something like OFC in March 2026 comes to mind. Those events are often where partnerships get unveiled, right?
They are. Any major customer win announced there would be a massive catalyst. And if you connect all this to the macro picture, The timing couldn't be better. We're seeing huge capital rotation in the AI sector, moving beyond the big chip makers and into the core component providers like this. Plus, the overall sentiment on interest rates favors these kinds of high-growth stories. The market is hunting for this, exactly this.
Which brings us right back to where we started, that core tension. On one hand, yes, the current losses are steep and the execution risk is absolutely real, especially with that high price-to-book ratio.
That's the bear case, for sure. But the bull case counters with this foundational technology moat, the market validation, and that huge $250 million cash cushion. It creates a really strong asymmetry for potential high growth that is linked directly to this massive, non-negotiable AI data center demand. They have the tech and the cash to survive. Now they just have to deliver.
So here's the final thought I want to leave you with. Think about the concept of switching costs in the long term. If POA Technologies truly delivers the cost and power savings promised by the optical interposer, and those early gross margins suggest they can, how quickly does it become virtually impossible for competitors to catch up? If the tech dictates operational efficiency, then eventually today's valuation metrics just cease to matter. That's the long game here, becoming indispensable. That's the lowdown on POAT Technologies for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.